and welcome to the latest episode of SFI Not So Live with me, Jay Evans, your host. Thank you for joining us. I'm joined by another interesting panel, all-male panel today. So coming to you first, Tony. Tony, do you want to do a quick introduction, let people know who you are in case they don't already know?
Yeah, hi everybody. My name's Tony Hall, Head of Mortgage Sales here at Saffron for Intermediaries. That's probably all you need to know, really.
Short and sweet. And I'm also joined by Simon. Simon, quick introduction, please. Who you are, what you do, where you're from.
Yeah, of course. So I'm Simon O'Donnell. I am the field-based BDM for Saffron, covering the south of the UK and London.
There you go, short and sweet. A little bit longer, hopefully. We've got a lovely special guest with us today. We're joined by Rob Jupp. Rob, welcome to SFI Not So Live. It's your first time here. Good to have you. Why don't you just let the audience know who you are? And I'm pretty sure they know who you are, but let's do it anyway.
Hello, Jay. Thank you for inviting me. So I'm Rob Jupp, the Group CEO of the Bright Star Financial Group. We have a small number of portfolio companies. The two that we trade in the mortgage industry are Bright Star Financial, that are one of the leading specialist distributors in the UK, based in Billericay in Essex. And we have Sirius Property Finance, which is our more of a high net worth boutique debt advisory business that's based in the City of London. We have just under 100 staff across the two businesses, and the business has been going for too long, actually, 11 and a half years. Goodness, I was just a mere young child when I started this business, wasn't I, Tony? Yes, good
Yes,
answer.
Rob.
Yes, so that's a very brief summary. I've been in the mortgage industry now, coming into my third decade. It's the only industry I've worked in, an industry that I, for my sins, deeply love and deeply enjoy working in. So thank you very much for asking me to join this today.
You are more than welcome. Thank you. And thank you for taking the time out to record with us today. We're going to be talking about some May news. This has been released in June 2022. Just as a caveat, some of the things we discussed might be slightly outdated depending when you listen to the podcast. So for those of you who haven't listened to us before, SFI Not So Live pulls apart some of the news that's affected the mortgage and property industry. And we sort of pull it apart, give our own opinions, and feel free to argue with us. Join us on social media and give your comments on what we're talking about by all means. So without further ado, let's dip into our first story today, which is from the Intermediary. The Building Society Quarter 1 mortgage lending is at the same level as during the stamp duty holidays, the headline. So figures released in May from the Building Societies Association. So the mortgage lending for building societies in the first 3 months of this year was on par with lending in the same period last year, when the stamp duty holiday was in operation. So we've still got a buoyant market. Tony, going to come to you first because we've talked about this a lot. But we've still got a buoyant market and no stamp duty holiday. What's happening? Is it as buoyant as it makes out?
Yeah, it's extremely buoyant. There's there's still far too, there's more people wanting to buy than there are houses available to buy. So there's a huge supply and demand challenge still, and we're extremely busy. We've had probably almost a record month this month in activity. So there's no sign of it letting up. I think the one thing that's probably masking these figures is the delay in completions at the moment. These figures actually are probably better than it looks. I'd say we're outperforming the pandemic because we discussed it before, but the average completion timescale moving out from that fabled 90 days to now roughly 157 is significantly impacting that completion time frame. So these figures probably could be, 15% higher because of the blockages at the moment within the conveyancing and solicitor world. So it's a very, very strong position for the building society sector. And I think as well, what's good is the fact that as building societies tend to support the normal customer, but very much so leaning towards more the customer that needs a bit more help, needs what building societies generally can bring, which is a more manual approach to underwriting and a broader approach to helping people with more complex issues. So I think it is all all leading up and showing up to being another bumpy year.
So, Rob, from a distributor perspective, you've got a wider market, wider market knowledge. What's it feeling like across all the different societies? I mean, presume the same, and the industry, certainly reacting to this positive market that's happening. But is there any particular areas of the market that are fueling this?
Well, Joe, we do work in six specific areas of the property market, which with Saffron we'll deal with actually almost half of those areas we deal with the Saffron Building Society. So we are very busy in all of our markets without exception, and actually the those of us working in this market this year would not be surprised at the headline. It's much busier than most times I've worked in for the last 30 years, which does make me a little nervous, I have to say. I think what we also need to think about when we're comparing like for like periods is January and part of the way through February last year was still a national lockdown, well, seemingly everywhere other than 10 Downing Street. So um, we were in a difficult trading area, and I think Tony's point is spot on. I think that legacy of the pandemic is still with us. I think that we still have a large chunk of the mortgage industry, particularly the support and the processing side that is working remotely, and I think there does lie a significant issue where there is just simply an over capacity of business levels coming into all lenders at the moment, and probably an under capacity of being able to service it. So Tony's point about the delay in pipeline is absolutely spot on. Those delays are actually becoming larger at the moment and not smaller. I think it will probably take a while for that to calm down. I think we're all busy as well with remortgage business. This is the most bumper remortgage business I've ever worked in right now. People are starting to get scared. They're looking at their products coming to the end. They're being told every day that their cost of living is going to go, and the cost of living is going through the roof. Inflation at 10%, your mortgage is going to be 2-3 times more than it is next year if you don't fix it now, which is utter nonsense. But that's the headlines that are driving activity. So, excuse me. So I decided to start coughing actually, which is really useful. Yeah, really good market in terms of activity, but quite a challenging market to work in at the moment. I'm not sure that too many of us are probably enjoying this market maybe as much as we should be, because it is very high intensity. There are problems,
Yeah.
and from what I hear with intermediaries, with certain lenders, and not Saffron, I hasten to add, they are spending large chunks of their day with lost activity. Just being on the phone, waiting and trying to get updates. So, yeah, bit of a challenge. I think it's a bit stressful out there right now.
Yeah, I'd agree
Simon,
with that.
you deal with brokers day in day out. Also, how is it feeling for them? I think Rob's pretty much covered it, but just from your experience in going out and seeing people, how are brokers and intermediaries reacting?
Yeah, it almost feels busier than it was last year during the stamp duty holiday. But every broker I speak to is just run off their feet at the moment. Every single one, and they're getting pressure from solicitors, valuers, vendors, etc., stuff like that. But showing no signs of stopping whatsoever. I spoke to a broker this morning who said that he's finding that his clients who perhaps would be looking at a 500k house or something like that, they don't want to move now because the cost of living, etc., stuff like that. Or I say they don't want to move. They don't want to move into that larger property. They're just narrowing down their sights a little bit, so it's a slightly cheaper property. So they still have every intention of moving. They're just again lowering their sights because of the the cost of living crisis. So again, no signs of slowing down.
Is there an end in sight though? How long can this go on for? It can't go on forever, surely. I mean, I'm opening this up to the floor, but it can't go on forever. It's got to show signs of slowing down at some point.
Well, yes, I guess all trajectories, like hot air balloons, they go up and they come down. I mean, I think any market is cyclical, but I think the interesting dynamic here is you have got the most intertwined, sophisticated mortgage market in UK history right now. you've got very much a suffering purchase market because there just isn't enough stock in the market right now, and I don't see that changing. I think that's probably going to get worse. Stock for estate agents is going to get tougher. I think you've then got, as I've said before, a really, really strong remortgage market, the strongest remortgage and PT market ever. And I think the third thing, almost in a counter-cyclical way, you've got a really strong PRS buy-to-let market that is absolutely flourishing. Even if we have a more difficult year, we're still looking at anywhere between 38 and 40 billion pounds worth of lending in that market alone. So, you know, if one market does suffer, the other markets are kind of there to step in, and that's the great thing. And this, all three of these markets are largely owned and run by intermediaries. So, you know, as Captain Mannering said in Dad's Army, don't panic, because as one diminishes, the others will continue. So I genuinely don't see there being an off the cliff Armageddon style overnight decay. There may be a reduction, but the reduction is going to be fairly modest over a period of time.
Tony, you look like you're going to say something then.
No, I was just agreeing. So for once, I shall be nod silently and let us move on.
There's something that Simon said actually before we move on to our next story. Something Simon said that intrigued me because during the pandemic, everyone moved to almost not necessarily upsize, but they moved to change the property spending on their new working life. So maybe moving somewhere where they had space to build an office in the garden, but the cost of living crisis, I know, is going to be hitting us for a very long time. There is the cross of that, isn't it? There's these people that have upgraded and thinking maybe, oh crap, I should have stayed where I was.
Yeah,
Or maybe they're in a larger house and thinking, I might need to downsize now, because our costs are too high.
yeah. There was an article. I think it was this week. I don't remember the publication, but I'm sure it was something like 25% people who moved during the pandemic wish they hadn't. So I think
That's
it's
telling in
exactly
itself,
that.
isn't it?
People were through that period, a lot of people kind of were upsizing and going from that first house to that third house rather than going to the second.
Yeah.
So they've overextended, and now it's starting to bite. So it's an interesting time. As Rob said, there is going to be contraction in the market. It cannot keep, every bubble bursts at some point. It's just at what point and how ferociously. But I don't think, as I said, I think we'll see contractions across markets, but we won't see any huge cliff faces, in my view. And every scenario creates an opportunity for intermediaries, and I think the point I would probably say is for a lot of it, for a lot of intermediaries, probably not the ones that we deal with so much. They need to diversify and think bigger and understand that there are opportunities for clients out there that they probably still say no to because they don't know the markets, and that's where the likes of us and Brightstar come into our own because we have that expertise to help them. That's the key.
Great stuff. Love the job. Well, we've just discussed, or we've just mentioned different types of markets. Let's move on to our second story, which came from Mortgage Solutions only a couple of days ago, actually. So on the 25th of May, self-employed individuals are twice as likely to get rejected for a mortgage compared to their PAYE counterparts, according to Exploring Adverse Credit Report from the mortgage lender. Sorry to brand, but it's a topic that we have discussed on many occasions. Tony, Simon, we talk about the self-employed quite a lot. It is an issue. I will come to you in a minute because Tony, I know you want to drop in a little plug there somewhere. But Rob, just quickly over to you. Across the board, self-employed. Obviously, the pandemic was an exceptionally unusual period. It's not something we could have predicted. The self-employed were particularly hammered, especially if they were in a certain bracket where they got no support from the government at all. This was inevitable that it was going to be more difficult for them. How bad is it for the self-employed? Is it really that bad across the board with lenders?
So this is not a new headline. This is just a lender that's used the opportunity to promote the fact that they do self-employed mortgages and use a headline that says that. I mean, any mortgage intermediaries that reads that would go, yeah, and what? Of course it is. It always has been. But the thing is
Yeah.
this: where most people that require a mortgage and they're self-employed in the special market, where they start their mortgage journey is in the wrong place. They go to, the bank that they bank with for years, that they perhaps have their business bank with, and they just think that because they bank with them and because they see the flow of money going through their bank account, um, like back in the day, the bank will have some sort of magic special stick for existing customers that you can wave, and they'll get a mortgage, and they often don't, because obviously the banks are heavily regulated and can't do favours to existing clients that often. So
Mhm.
they start in the wrong place. That's the truth. So and sadly, you know, some people are not very robust. They get turned down once, and they give up. Oh, I can't get a mortgage because my bank's told me I'm not, which is very, very often not the case. And then if they're able to have the fortune to speak to a good mortgage intermediary, of which there are 30,000 of them in the country, and a good percentage of those would be deemed as good intermediaries, I'm sure. They will look for a number of lenders, including the Saffron Building Society, that has a very, very good proposition for the self-employed, and they'll have underwriters and people that are qualified and aware of what to look for. So this is not, this is not a pandemic created. I mean, let's just blame the pandemic for everything that's going wrong in the world at the moment, shall we? I mean, a good chunk of it, I'm sure you can blame it for, but this one you can't, because only, most people who were self-employed did get government support via furlough or via CBILS or bounce back loans. Those that um, um, came into the pandemic, many of them were holding good reserves of cash, so they're able to cash flow themselves out reasonably quickly. And because a lot of these people, it was their companies, they probably did take more risks to the house. They probably did get out there a little bit sooner than others did. They probably did get out of their bunkers before most of us even thought about it, and because they're entrepreneurs, a lot of them. So yeah, I think it's not as bad as this headline would suggest. I think as long as you go in the right place, you know, a big percentage of the UK SME will be able to get a mortgage.
Tony, just picking out a few bits of that. I think we agree. Being self-employed has never been easy to get a mortgage. We know that, but just on the effects of the pandemic, let's just quickly tap on it. There were elements. These bounce back loans or grants were the biggest issue. Is that going to continue to cause a problem? Is that really a problem, or is it down to the fact, as Rob just said, it's the right intermediary for the right and the right product?
Yeah, it's the latter. I mean, what Rob said was what I was. If you'd have come to me first, I'd have virtually I would not as eloquently, but I would have mirrored that in terms of it. If you ask the wrong people, you'll always get the
Yeah.
wrong answer, and I think that's exactly what's happened here. So, but I do think that the pandemic has helped not help it's helped lenders think about the self-employed in a slightly different way, and look and really look to support. And so we obviously, we along with a few others have gone, right, okay, well, let's remove that pandemic year. We've got excellent underwriters that understand self-employed, so they can look beyond an economic situation. Sadly, a lot of people have tried to use the pandemic as an excuse for a failing business and then try and get a mortgage. So we've seen a fair deal of that. But look, we've always had the view that if you took the loans, if you took the grants, then that was the right thing to do. It was being offered. If someone's offering you cash to support you, and you can be justifiably taking it, then we will happily overlook that or build that into our scenario. And it doesn't mean it works for everybody. So I think the pandemic's helped from that perspective. We're more cognizant of the issues that people face, and will do that. But it is very much down to the self-employed finding the right lender, and if they're not comfortable themselves, then they go to intermediary that either does it themselves or comes through Bright Start with their expertise or other packagers and distributors who will help them do that. So it's funny. I think I said this before, but I was in the hairdressers, and I know I
You
still
need to go
just
to a
about go.
hairdresser's?
It's not doesn't take long. So yeah. Thanks, mate. As I said, I go and have it stuck on now rather than taken off.
Do they help you with
So,
comb over?
but yeah, thanks, buddy. Yeah. Yeah. The yeah, it starts at my armpit and goes over the top. So, but I was chatting to a guy there. He was like, "Oh, I'm self-employed. I'll never get a mortgage." I was like, "No, you will. You can get one. There'll be a cost for it because of whatever scenario you're in. But don't think you won't get one. You know." So I think it is. It's that plea to go and get professional advice. That's the plea we always say. Go and find, as Rob said, a quality intermediary, and there's a lot to choose from. If you ever need a help doing that, we'll happily help you, as I know Rob and his team would as well. So
just bearing in mind that
yeah,
the good majority of our
don't.
audience are intermediaries, maybe it's more telling the intermediaries to go to the right people for the advice and going to the right lenders to spread their wings, as it were, or go through a good distributor and find the right products. Because as we know, there are so many products in the market and there's a lot of changes happening, but actually it is really about the product, isn't it, Tone?
Yeah, it is. And I think just going back to that, the key thing that intermediaries can do when they're approaching a lender is have the story clear. If it's not an obvious case, we always say, as you know, Jay, tell us the story,
Mm-hmm.
but do that, because it makes it so much easier if we can look at it once and go, oh yeah, that makes sense, that's fine. If we have to go digging, then that's where the delays come in, and then the more questions get asked, and then it just doesn't help. So just be upfront and tell us what it is exactly you're looking for. That really helps us as lenders.
One of the things I've been working on, away from this podcast and the webinars, one of the things we've been working on is the change in working patterns since, sorry to use it again, the P word. But there are more self-employed people, believe it or not. People diversified. Some people were self-employed, started doing things that they were passionate about. And actually, you've obviously heard the great resignation, loads of people leaving employment to go and start something new and something they were passionate about and excited about, due to their change in life thinking since they were locked away. Simon, do you get more brokers come to you with self-employed applicants now? You must see an
Yeah,
increase.
definitely seen an influx since the pandemic, and you've got people that have gone self-employed since the pandemic that are coming up to finishing up their first proper year now, and that's where we can help out. As Tony's mentioned, and Rob kindly as well, we try to do our best for the self-employed, and we can help those with just their first year's books. So they might have been made redundant during the pandemic. They might have thought, do you know what, I don't want to do this anymore. I don't want to work for an employer. I want to work for myself, see my kids, etc. These are the types of clients that we're seeing come to us, and in any industry as well. So a real array of industries coming across. But yeah, definitely an influx in self-employed applicants, particularly those that have just started out.
I think if we're going to give one bit of advice to the intermediaries in the audience, is just look around, get some advice, speak to BDMs, have chats with the people you trust, because sometimes it's not as straight laced and as straight down the line as you think. So thanks for that, guys. That was a nice little chat on that, because I've always wanted to champion the self-employed. Not that I'm self-employed or anything. And then on to the next topic, which is from This Is Money from the Daily Mail. And it's all about longer fixed terms. We've never really discussed this, Tony, have we? It's never been a thing we need to discuss. It's all relating to and it's all relating to this cost of living crisis. For the sake of the recording, we are the day after the Chancellor's just announced a package to help people across the board. So that's just to give us context. But Tony, actually, I'm going to come to you first, Rob, actually, on this one, on these longer fixed terms. Do you think this is even feasible? Do you think this is something that even catch on?
I don't know. I mean, I think it's the definition of one broker's definition of a long-term fixed rate is perhaps different from another. I mean, my definition of a longer-term fixed rate is anything more than 5 years. Actually, I don't know whether that's the industry definition or not. But if someone's coming to me and as a friend, I hasten to add, not as a giving them advice, close brackets, and says, would you take a long-term fixed rate? The rates seem really cheap now. I'm probably not going to be saying that too recently actually, but if they did, I would have some concerns about anyone committing to anything for more than perhaps 5 years, simply because, I don't know what the latest statistic is. Is it still 1 in 3 marriages end? It seems to be in this area. It's more like 4 out of 3 that seem to end. I don't know, myself excluded, of course. But there's matrimonial splits, there's relationship splits, there's people losing jobs, there's people changing their mind. We talked about the sort of the people who had too much time on their hands during the pandemic decided to use it by moving property. Some of them will unwind that. Sometimes people's jobs, still change. Relocation's not a thing of the past. We can't all sit in our gardens forever working. So all of those things I'd have concerns with. I think and also from an advisor's perspective, I guess I'm probably going to call this as I see it. There's not that much commercial advantage to an advisor for fixing the rates too much longer, because they will lose the customer,
Mhm.
and there won't be the ability to either do a PT or a refinance. So, you know, just a question mark. I mean, the 40-year fixed rate, went down as well as was expected. I think like a lead balloon. Probably there was more lead balloons sold that week than there was those 40-year mortgages, but that was just headline making. I mean, it was a nonsensical idea. The bit that I think would be really interesting, but I think you're probably not be able to get it through Sonia and swap rates, will be the ability to perhaps agree a payment rate for a period of time and then have the flexibility to come out of that at any point. But of course, as most intermediaries will understand, the way that most loans and mortgages are funded is they're raised by retail funded bonds by savers. So you're fixing. You're able to fix a rate for 5 years because you've got a load of cash in on a 5-year fixed rate savings bond. So
Mhm.
trying to get flexibility on that, I think, would be really, really important, and but really, really difficult. And I think that's the problem. I think the market is unable to be that flexible in product design because of the way it's funded.
Yeah,
Tony, you're
I
nodding away.
agree. Look, it's a long-term fixed rate for some clients might be absolutely the right advice. They have no plans to move. They have no plans to do X, Y, Z. They desperate for that certainty. It might be, but if anything, the last 3 years has taught us, nothing is guaranteed. Everything can change. So an advisor is going to be really drilling down into that person of what's their plan over the period to ensure that they get the right term. It's like first time buyers being locked into long term fixed rates in their first home. It's I don't understand it, because most first time buyers don't want to stay in that home for long. So they end up after 2 years wanting to move, and they're stuck with a big penalty for doing so. So it's a challenging one. And that's again why you need to find, or why consumers need to go to the right intermediary to get that advice. I think Rob's right in terms of how to fund longer term deals. It is a bit more challenging for for the established lenders. Particularly the retail banks and building societies, as I said, have got a retail savings model that does a lot of their funding. I think you've got an opportunity with challenger banks or new people coming to market who are promising longer term fixes and making it easy and providing that flexibility. So I think it's going to take somebody to come in and show that the world can operate on that long term basis. But I think there's always going to be a penalty for fixing something for long, because you can't have the cake and eat it. In my view, there's one or the other. So there's an impact of having that security. So, but I know there's lenders on the way who've got their banking licenses that are going to come in and offer longer rates. So it'll be interesting to see how they do it and what get out clauses they provide as well. Because I think once we see that, then you'll start to see more innovation. But I think for most lenders, it's still we'll certainly watch it from a distance and get involved if it's the right thing to do, and it looks the right thing to do. So this has been rumbling on for years,
Well,
to be honest. It's not a new thing.
No, and actually, Simon, feel free to chop in at any point here, but the Bank of England are going to have to put the base rate up again. It's a given. We know this is happening, and we don't know where this is going to go. But the cost of living crisis is going to be with us for a fair amount of time. People are going to be tight and penny pinching. Simon, just on sort of broker conversations, applications you've got coming in now, how is affordability looking for people? Because there is a real pinch, even on those of us would be deemed as middle class. There's even a pinch on us now. Everybody's feeling the pinch. How does
Yeah,
it feel for you putting in and working with the brokers at the moment?
a lot more brokers are looking at 5 year fixes now as opposed to two. So our sort of stress test and what we can lend, probably like most lenders, is we can lend more over a 5 year period. So they're tending to opt for that because, like you say, affordability is becoming harsher, and with every base rate change, the SVR, etc., stuff like that. But in terms of sort of longer term, I mean, I don't think I've ever had an inquiry for a 10 year fixed or anything longer than the 5 year fixed actually at all. So perhaps that's because brokers know we don't offer that service, but it's not something that I've seen at all really. And you could argue that if you're ever going to see it, it's perhaps now with the cost of living, the bank rate on the up type thing, and still not really seeing any signs of it now.
I think we are still, as weird as it sounds, we are still really early in this crisis. We don't know how this is going to pan out. We don't know how October is going to look when the next price cap on the fuel goes up. We don't know what the Bank of England are going to do. We don't know if they've reacted right as it is, and it's all. I think we could sit here and speculate all day, but we can't predict everything. So let's wait and see. But as
Jay, can I just
yeah,
can I
just come
just
on,
say at this point though, I mean, this whole, we have to be really careful with the language that we use in our world, and I think anything that's Ukraine is a crisis. There's no two ways about it.
Mhm.
Energy bills going up certainly feels a real problem for a lot of household budgets, but the good news here is this, that this wasn't something that just happened. We had plenty of notification it's happening, and probably like Tony, like most dads in the world, has been busy going around turning lights off and moaning about windows being left open. There's so much we can do within our green footprint now to actually wake up and care about the planet by actually reducing our carbon footprint and using less energy. And there's a real now incentive to do that, because your your bill will still go up, but it certainly might not go up as much as if you use the current framework. I think people are looking at their household spending. Food's a big one at the moment.
Mhm.
People have experienced that in their pocket. But what I've learned from working with British customers for 3 decades now is they're tremendously robust. If they have to adapt, they will, and they'll make savings in any way they can. One of them clearly is, the big one is the mortgage, but people will start to trade down cars. They'll
Mhm.
start to think about numbers of holidays they take. It's just an economic necessity, and this is not. Let's be really, really clear. We've not just been invaded as a sovereign nation by Russia. We're not becoming homeless, and our fuel bills are going up, and we've been given 6 months notice of this happening. We've just got to get a grip on it. We've got to understand that there's a lot worse things in the world going on than this, and we've just got to do what we've always done, which is just find a way through it. I know, you know, there might be a few people screaming at the screen saying, "Well, that's just easy for him to say." Everybody's feeling it. Everybody feels it, and psychologically, we are all starting to behave and act slightly differently. But again, I'm not sure that that's necessarily a bad thing anyway.
I agree with you in some points that we need to look at ourselves a little bit. And you're absolutely right. Look at the way we're managing our money, how we're doing that, what we can afford, what we can't. Um, and I think there will be some people out there who are looking, thinking, "Well, it's all right for you guys. You're in a white collar job. You're earning well. It's probably not hitting you as hard as it is some of my clients who are perhaps looking to buy." But as you say, and I completely agree with you. I think this is a time to educate, and maybe Tony, maybe you could chip in here, but do we as lenders, as a market, do we need to start giving brokers the tools to give to their clients to educate them and say, look, it's not a crisis for everybody. It's an opportunity to change, an opportunity to for alternatives, an opportunity to, as Rob was just saying, maybe manage our finances a little better and look at our lives a little better and look at those.
Well, yeah, look, it's this we've had this debate before,
Mhm.
and so it's one I've always gone about. It starts at school.
Oh,
There's the level of financial literacy in the UK is still very low. Is because it's not a curricular subject. It should be. We should
just
have there should be a school of life exam for everybody to understand what goes on and
to
yeah,
interrupt, Tony. Tony, we're an older generation than Simon. So between Rob and Tony, a straight answer. When you were at school, did you learn anything about borrowing, about interest rates, about mortgages, how you buy a house, where that goes
no,
afterwards? What you're buying a house for? No, neither
no.
did I. So that's from us older middle-aged ones. Over to the youngster, Simon. When you were at school, did you get any help with anything
Nothing
like
at
that?
all. Not even
No.
mentioned. I wouldn't. No.
Yeah, see, point proven, Tony. I agree with you. I think education needs to start
Yeah.
from a very young
So
age.
you've got a lack of financial literacy. You've also got you've had more than a decade of benign interest rate movement and
Mhm.
low access, easy access to cheap money, right? And it's now starting to go up, and it's just going up at the same time as everything else. Obviously, it's one of the fiscal mechanisms
It
to try and
yeah.
stop it. But so, I was just sat here thinking about it. My first mortgage, I was delighted because I fixed it at 8.99. And
I was about to ask you
the,
what that
the,
was.
the,
Actually, I was going to ask
the
both you and Rob
the
what your
kids
first
the
interest
kids
rate
of
was.
today would just melt if you said that. So we've got a generation of people trying to buy their first house or buying their second home. You've also got a generation of advisors that have never had a rate increase as well. So you've got all of that. And as you say, Rob's quite rightly said, let's put this into context. This is an economic cycle, not a crisis. And we'll get
Hmm.
some, and there'll be winners and there'll be losers. Some won't be driving around in their flash cars like they used to, or if they are, they might lose their house as a result if they don't do things right. But we've got to look and go. Actually, it could be a lot worse. And as you say, that is a spectrum, and there's a lot of people who are, being put into poverty in the UK as a result of what's going on, and we need to support them. So I think back to the education pit. I'll get off my soapbox now before I break a leg. Is it's education to support brokers to support their clients, but it's also education to support brokers. And that's what we're looking at. What tools
Yeah.
can we provide that help them help our intermediaries help their clients. So back to your point, Jay, we are looking at how
It,
how can
it's
we do that.
generational
Yeah,
education,
it
isn't it?
is, but
It's
we need
generational education. It's not just
we
the buyer; it's actually the brokers. You just said it
yeah,
bang on, Tony. There's brokers that have only been in the
exactly.
market 5 6 years. They've never
But it
seen some of this.
starts at school. We need, I don't know why there's not a curricular thing that just talks about finances and how to do stuff, because we wouldn't necessarily potentially have that much
I mean,
personal debt
Tony,
if we
can
did that.
you scratch your heads and we're panicking about 5 year fixed rates starting with a three
I
now.
know.
I mean, I almost want to
Mm.
get a wet kipper and slap myself around the face because it is kind
Yeah,
of mental, isn't it? It really is.
yeah. Oh, it is. It's like, oh my God, rates are at 3%. That's horrendous.
Yeah, yeah.
Well, maybe we should start an education program for brokers when they start out, and these new brokers, and just say, look, we've been through a hell of a lot worse. When a couple of decades ago, it was a hell of a lot worse than this, and it can get worse than where we are now. But actually, let's not let's not absorb the word
Yeah,
crisis that the
I mean,
media like to use, and actually go, it's an issue, it's a problem, but it's not something that we
yeah.
can't
And
overcome.
again, it's like it's not a new problem. Back in the day when I was running branch networks, we had a schools education program. We used to go into schools and teach them about
Hmm.
building societies and saving money and stuff like that. So it's possible if we people want to do it, but it shouldn't.
Can I just interject here, actually, because Tony, you might not be 100% aware of this, but Saffron do actually do that with a partner. So anybody listen to this podcast, if you're interested to know what that is, because they are very encouraged if parents can come to them and say, "I'd quite like you to come in my school." They're a charity. They do require funding, but they are absolutely brilliant. They work in East of England. So if you listen to this and live in East of England, look at the text with this podcast. I'll put a link on for you. Get in touch with them because they do go around schools, exactly what we've been talking about. They go around and just break down what money is to children from 5 years old. So it really does put it front of mind for them, and they start asking questions to their parents, and they tend to find they're doing more. So a little bit of a plug, but it is a charity, so I think
Yeah.
I can do that. So we do that. I will put the link in the text with this podcast. Have a look, guys, and if you're parents, take it to the school and say, look, you can get these guys in, we can educate our children, and we can start this cycle. And maybe it will encourage the government to think that actually finance should be, part of your maths GCSE, maybe a big module of that should be money for life and what money means for your life. And maybe people won't be plummeting themselves into debt as soon as they turn 18 like I did. I love a bit that. Okay, so let's move on. That was really good, guys. Thank you for that. Any comments on that? Please get on the social media channels. We'd love to hear your thoughts on it. Topic 4. This one's from the intermediary. Due to poor internet connection, I can't open it, but I know what it's about. So this is 50% of professionals in the industry are feeling that down valuations are growing in 2022. Tony, we've talked about this already. What's the problem here?
Well, yeah, down valuation. We see quite a few at the moment. I think it's. I don't think it's down valuation. I think it's the correct valuation for a property that's been overinflated because everybody thinks their home is a castle and is worth a lot more than it should be. Yeah. So it's, all of us, you look at next door and they sold it for that, but you don't know what's inside there. So I think it's a feature of the market. We are seeing more of it, but I think that's because of the inflation of house prices generally. I want to broaden this conversation to say one of our biggest challenges is actually getting a house surveyed because there's a shortage of surveyors again. That's the biggest issue that we currently face. Our panel partners are struggling in certain locations because there's not enough surveyors. It's one of those industries that seems to go through this, and Well, I'm sure remember this, it goes through this cycle of not having enough people coming into it. And I think we're heading for another one of those because we are really struggling. And I know Simon does because he's in my ear every day saying like he's getting grief from brokers because we can't get a valuation.
Yeah.
Si, do you want to comment on that?
Yeah, it's particularly over the last couple of weeks, it's really shown itself that really struggling with valuations. So some of them taking like 4 weeks to book in and stuff like that. And if you've got a new build and you're getting grief from the site or from the builders, we want to complete by X date, and it's really difficult to escalate because obviously the valuers they're fully booked up. It's not like we can say, look, can you do us a favour? Ultimately, they'd have to take someone out and put someone in for us. So it's, their hands are tied. Appreciate that, but yeah, really frustrating at the moment, to be honest.
I think new build developers have got a lot to answer for, particularly in these two peaks. The end of June, end of December financial year sort of scenario where they just put too much pressure on their intermediaries they work with. That put too much pressure on lenders that snares up almost the entirety of the market for their financial gain because they've got to complete on these transactions. And if the brokers don't, they run the risk of being fired and being replaced. It's that ruthless. I think the thing that we just not got to just acknowledge now is when you're coming into a cycle where the dominant type of transaction is like to be a remortgage. You're just going to have more down valuations. To Tony's point, exactly. And I think what would be hugely beneficial and useful is tools that allow clients to get a firm indication, even on an AVM basis, what the house is going to be worth before they go in and put the application in, to prevent them. If someone thinks the house is going to be worth, I'm going to make the number up, 500,000. And it's not worth more than 400,000, it's never going to end happily, is it? They're just going to waste a load of time and resource and block an already fairly congested artery causing cardiac. So I think that I think, if we all accept that the remortgage world is going to be the dominant type of business for maybe the next couple of years, I think we probably, as an industry, and valuers, need to help with this. Need to find a interim solution which allows clients to get an indication of what the house is worth before they waste time.
Yeah.
Tony, just picking up, you said that this is a cycle thing with valuers generally, and getting valuations like a cycle of people coming through is, and to Rob's point about getting that, looking at the system and looking at a way of doing it differently. What's the cause of that? Do you think, is it just a natural cycle? Is
Well,
it just
I
lack of
mean,
interest in the industry?
I don't, this is a personal view. I'm not expressing
Hmm.
this from any other annex of my own, but because I've been around long enough, I've seen it happening. Um, a bit
Yeah,
like, well, there's not enough people um, who want to be a surveyor. It's it's a bit like mortgage brokers, really. None of us aspire when we were in school to be a mortgage. Well, I certainly didn't, and I'm not sure if it's the same with surveyors. So there's a lack of talent filling up the pool of surveyors, and it's what I've seen, and we see this cycle of there being significant lack of new blood into the market. So that's what I can't say that's what's happening, Jay, but it's what I've seen before, um, because you'll have a whole rough.
you kind of picked up on a bit of a theory that I have, in that a lot of the work I've been doing recently, because I'm working in the sort of employment and industry market at the moment. A lot of work I'm doing is around the amount of jobs. We've now got more jobs than we have, or more jobs and less people in work. So there's actually I think, is it 1.2 jobs for every person or something stupid like that? But anyway, it's now at the stage where I don't want to use or go into politics, but Brexit took a lot of people away from industries. There's a lot less people in the country that are willing to work. There's less people to work. So actually, now people have got more choice. But I was trying to identify if this market, whether it's surveyor market, conveyancing, or whatever it is, conveyancing market's the same. It just seems like we don't have anybody coming in to aspire to be in these markets yet. We've got a very buoyant market. It's a strange. But then, saying that, if you think back 10 years, where when they started in education and thinking again, as you said, Tony, what they're going to do for a career, I guess if the market didn't look that great and it didn't look that exciting, why would you want to?
Yeah, it's a challenging, but I think the answer, going back to Rob's point, will be technology. The technology already exists with AVMs, etc., to ease a lot of the strain in this market already. So, but the the thing that's got to evolve is the risk confidence to use an AVM above a certain figure. So AVMs are great up
Yeah,
to
yeah.
say 70%, and that's probably stretching it. Most will probably cap at 65. So if you've got models that allow an algorithmic assessment of a house that a lender can get comfortable with to a higher value, a lot of this challenge goes away, and I think that will come
Mhm.
over time as more and more confidence in those statistical models works, particularly in that remo market, because
Mm.
it then just takes a lot of this just out of the equation. And as Rob said, if you've got the technology up the front for the customer to have their eyes wide open coming into the transaction at the start, then you don't have the big surprise. But again, there's another article I read this week about 1/5 of remo deals are bought at the moment, and I'm wondering if that's maybe linked to this
Yeah,
sort of the whole down valuation piece.
yeah,
Mhm.
yeah, for sure. And Jay, the other really really important thing here is, this problem was identified 5 years ago by the mortgage industry to Ricks,
Yeah.
and we were saying, 5 years ago, when they were saying, the great news, it's a really experienced industry because the average surveyor is 61 years of age. We're like, guys, you've got a problem there. You know, you see that as great. We see that as terrifying. And they did very little. And the
Yes.
reason why they did very little is the UK valuation industry for property is in the hands of a very small number of people who, frankly, looked at the long term play of physical property valuations and believed at this point, I really firmly believe this, that they wouldn't need as many surveyors as they had. So surveyors were made redundant 5 years ago. They weren't replaced. There wasn't massively significant graduate schemes. They've all got a few, but they've taken on fairly small numbers of headcount. AVMs haven't moved on that much really in that period of time. There's still that concern about how reliable they are, and the problem now is the gamble has proven wrong, because you've got a very much a decaying sector in terms of age, because it's terrible. Actually, I've got to stop using, when I talk about people getting old, as decaying, because I'm in that category myself.
Okay.
It's the most horrifically.
So trust me, I
I
know
know
how
it's the most
I know
horrifically
how that
visual
feels. I feel
cue,
like I'm
isn't it?
decaying.
But no, seriously, um, the mortgage industry, in complete contrast, needs to be congratulated. You look at the diversity and inclusivity of our industry versus the surveying industry. It is a quantum leap.
Mhm,
And 5 years ago, we said, join the revolution. We're seeing that we've got the same problem in the mortgage industry. We think that if we don't do something about it, we're going to have significant issues. And we developed, and we went to younger people from outside of the industry, and we brought them in. And as a result of this, now
mhm.
you've got a really fantastic, diverse, and inclusive industry. It's not the same for valuers.
Yeah.
And others in the chain as well. I think I've seen that too. Tony, you were about to say something then, but I've seen the same thing. I couldn't agree with Rob anymore. To be honest, it's the other people in the chain should have watched and seen what the mortgage industry was doing and going, "Oh God, we're not keeping up." Surely.
Well, it's kind of a institutionalized thing with the mortgage industry. We can be a bit slow to evolve across all parts of the chain. There's a lot of great stuff, but sometimes the big dinosaur that is the mortgage market takes some turning at times. So, but it is, as you said, it does improve it's just one of those areas. It's the bulge is here, we'll flatten that, and you'll have a bulge here, and you'll flatten that, and it'll pop up. It's just life. It's any market, any industry. It's how you deal with it that matters, rather than getting too stressed about it.
It'd be interesting to see what they do and what incentives they can do to bring people in if there is that much of a shortage. Let's hope somebody's sitting there going, "We need to change and we need to attract young talent." Hopefully, they're doing that. As Rob said, we could use some fresh blood. So, on to our final topic. We have just 10 minutes left, so we'll jump onto this one. I picked this one not so much for the fact of the headline, but actually the buy-to-let market in general. But the story says about landlords helping their tenants during financial difficulties. I'm not going to use the C word. They've been supporting their tenants. But I wanted to talk about the buy-to-let market. We've already touched on it earlier. Rob, you brought it up earlier as a really strong market, and it's still going strong. Tony, I know we've had this conversation as well. Um, there are going to be some issues for some types of landlords coming forward with new regulations due to come out for buildings, but at the moment, it's a nice strong market. But there is issues now. The rental audiences, those that will be your tenants, if you are a buy-to-let landlord, are going to be suffering probably as we said, it was scalable, the lower end of the scale financially are going to be struggling with rents. Is that going to put people off heading towards buy-to-let? Rob, should we start with you?
No, I don't think it will. I think any change to anything will put off people, but I don't think they'll significantly big enough to have any type of market realignment. Um, you've got a significant number of people now in the country that have a significant number of properties. They are professional landlords. They
Mm-hmm.
run these businesses like a PLC, and some of them are actually PLCs actually. And they always look at um, buying stock, getting value, re-leveraging
Mm-hmm.
portfolio. I mean, we do, particularly with our serious business, we do a phenomenal amount of really big corporate restructuring stuff, which are, sometimes the quantums of
Mm-hmm.
20, 30, 40, 50 million pounds each trade. So there's no loss of appetite. I think, the article, again, maybe I'm a bit critical, but the article about landlords supporting tenants in crisis, again isn't a new thing. I mean, I think landlords have seen as a bit like the Rigsby character in the 70s,
Yeah.
sort of the slum landlords. That couldn't be further from the truth. From most landlords I deal with, they're professional people. They have pride in the job that they do. They try and support to get the right people in their properties to look after them. If there's ever problems, they're on the move reasonably quickly, and it's a really good, well run. I think the challenge, the big challenge for that will be EPCs in 2025 and getting to 80 ratings. That is a
Yeah.
significant that's not just a bump, that's a revolution. But again, there's a 3-year
Mhm.
notice period here, and the challenge will be making sure that when you as an intermediary do a deal for your customer, that you keep those EPC and the cost of those EPC amendments in your mind, because they will probably need to borrow at some point. And what there is a growing issue that if you're dealing with a lender that raises money via the capital markets, they are not in a position often to be able to give you further advances or allow second charges. So that's just a little bit of a question. If
Mhm.
you're doing mortgages now in buy to let, keep the EPC changes in mind and have the conversation with the customer. Right, the cost of the average EPC upgrade is going to be at least £10,000. Have you thought about how you're going to fund those?
Mhm.
Yeah.
And that was quite interesting, actually, because you touched on something I was going to go straight to Tony with, which is the move from hobby landlord to business landlord. Because I think from a general consumer perspective, if somebody's just listening to this podcast come along and they don't work in industry and you think of a landlord, you think singular. You think they are just my landlord, they've got one property. But these people, as Rob said, they're professionals. And Tony, so the increase in limited company buy to let just kind of proves that but you're in that market now, and it was immediately popular, wasn't it?
Yeah, it is. Yeah, I mean, there's a lot of people moving to limited company status because it's more tax efficient to do so, and it's easier
Mm-hmm.
to trade in that. I do think over the years of the government putting the squeeze on landlords in terms of what benefits there were and the extra increases in tax and the extra stamp duties, that people are going into this because they're serious about doing it. It isn't the dinner party landlord, which is the old phrase. So there's definitely, which I think is a good thing, because you've got people who are doing this for the right reasons, not just because they thought they got out a bit of extra cash. So that to
Yeah.
me makes a far more professional market for both a lender to have comfort and a tenant to know that they're dealing with somebody that actually does understand their responsibilities. So I think that's a key thing for me. Rob's quite right with the EPC. That is, as you said, that is a major change, and we're looking at how we support that at the moment. Looking at our internal processes and how do our buy-to-let customers borrow more from us. How do we make our process easier and more accessible for a landlord to raise those funds? And then this is the shameless plug. And then on the other side, we will be soon bringing back our light refurb product, buy-to-let refurb product, back to the market, which, I'll be very honest, wasn't designed as an EPC buster. We've had it in previous years. We withdrew it when we stepped back a bit from the buy-to-let market due to our doing too much of it and our balancing figures. But that product will allow a landlord to make cosmetic changes to the property, which we'll fund. Okay, so we see a perfect home for it, for people buying a new property as a landlord, but wanting to get that EPC up now, so they might want to do the kitchen or the windows or something, and we will happily look to support that. Or for those who are already doing it and looking to remo their portfolio into a product where it's cosmetic and they don't want to go down more expensive routes, then that's what we're bringing back. It should be sometime in June, I hope, but I won't say for sure, because as you know, my colleagues in product will be screaming already because I've even mentioned it.
I
But
can't believe you've done it. You can't see me on camera because I turned my camera off, but I'm wincing because I know I'm going to get in trouble when this
well,
goes out.
I told everybody. I've told everybody at the Mortgage Advisor Expo on Wednesday anyway, so it's a bit late now.
So practically the whole market knows already. So this is no shock to
And at the
anyone.
Mortgage Strategy Awards after a couple of glasses of the bubbly, so that the cat's out
Oh,
of the
Simon,
bag.
I've told you to keep the bubbly away from him. He gives away far too many secrets.
There's no stopping him. There's no stopping him.
That I know. Simon, just quickly, just because we've only got a couple of minutes left, but I do want to get your opinion on this from the broker perspective. Are we seeing some new landlords now? We talk about non-hobby landlords and these sort of business landlords, as it were. But there must be some fresh landlords coming through too, because I'm thinking city professionals not being able to buy in the city. We discuss this often that I'm in my mid-40s. My friends all worked in London, bought in Norfolk, and have now moved in the houses they bought that they rented for about 20 years. That was the way we did it. Is this happening? Are you getting some fresh faces coming through?
Yeah, definitely. So like you say, you're living and renting in London, you want a foothold on the property ladder, so you buy back home. London's too expensive, or even happily living with parents but want to get that foothold on the property ladder. We do a lot for that, and we are definitely seeing a lot more first time landlords, but that could well be because we offer first time buyer, first time landlord, which is a bit of a USP in itself, so people know to come to us. But yeah, we see it quite often. Exactly the type
And
of
to
scenario
Jay as well,
described.
expat is on the rise again. We're seeing a spike upwards in expat landlords.
So quickly on expat, I want to just explore that very quickly. I've only got a minute or two left, but just very quickly on expat, Tony. Obviously, the EEC's out. Is there any sign of that coming back in, that people can start to apply from the European Economic?
Yes, we pulled out of that market after Brexit until we were sure about all the legalities. I'm pleased to say that as with effect from Wednesday, we are now lending back to where we were. So we're now lending within the EE8 as well, with one exception, which is the Netherlands, and that's due to their legal requirements and not wishing to deal with non-Brexit countries. Okay. So they are currently not on our list. But apart from that, we have no restrictions again, which is brilliant.
Thanks, Tony. So that's all the time we've got today. So a big thank you to the panel today for joining me and for taking the time out of their schedule. Thanks, Rob. And we will be back in July. Just so you know, SFI Live, the webinar series, is back in August. We're currently on a summer break with a brand new platform. So do look out for that on Saffron for Intermediaries, should I say, get my teeth in. Social channels, so just search for Saffron for Intermediaries. But from me and the panel, a big thank you for joining us.